Family Law Act does not define value. It talks about fair value, but not like fair value as a term, but let's be fair. So it's not actually defined, and 99 times out of 100 we use the fair market value, which is the one that the CRA uses, the one that people kind of associate with it. But there are other definitions of value too, and sometimes we use those. One of them is the value to the owner. And I'm going to talk about stock options in valuation toward the end. But that's not fair market value, because you have options in a private company. You can't sell them. No one, they're just not capable of being sold, but they have value to that person. And fair market value, it's a let's pretend exercise, and that aggravates the bejeepers out of whoever's looking at that, the two parties, whether it's high or low. One wants it to be as high as possible, and the other wants it to be low. And so you get a lot of comments like, well, nobody would ever buy it. It's me. It has no value without me, and everything, I've heard the gamut of whatever. And then the one that wants it to be high, doesn't matter whether he's there or she's there or not, and on and on and on. So I'm like live examples as I go through this stuff. So when we do a valuation, generally speaking, we either value a business on an earnings basis, which means we try to figure out, okay, what's the cash flow that's going to come out of this company that the owner can take out. That's what drives the value. And the perspective that we have when we do that, it's not like buying a business to work in it, because sometimes some businesses are just really, the person has a business, but it's basically a job, and I call them a one-man band kind of operation. Here in Ottawa, there's 1,000,001 former government employees that have consulting companies. It's really just them. They're just employees through a corporation kind of thing. So we try to figure out, okay, what is that worth anything? What kind of cash flow can they get out? If there's apparent that there's no goodwill value, so those one-man bands, nobody would buy the consulting business of a former civil servant that's now consulting for twice the money to the department that they let them go because they were too expensive for, and say, I'll buy your business, because the business is the person. And I'm going to talk about that in a few minutes as well. So when there's no apparent goodwill value, the value is just whatever the assets are in the company. Real estate holding companies are like that, investment holding companies, because there's no, the value is what the value of the investments are, the value of the building or the value of the investment portfolio or whatever. But if we go to an earnings-based value, we have to look at two things. One is how the business is financed. A lot of owner-managers, they're just debt averse. They just don't want debt. They, that sort of, pay off the mortgage and, get rid of all the debt. And that's fine, but sometimes it's prudent to finance or share the risk with the bank. The bank financing is cheaper than equity. So the cost of your investment is a lot cheaper if you can get 8% bank loan instead of, let's say, 20% return you need on your money, because you have a lot more risk than the bank would have. So we kind of adjust the balance sheet and look at how it's financed. And if there's no debt and there's a building there, we'd say, well, you could probably finance the building and take that money out. And if I bought the business with the building in it, if I didn't consider that in my sell price, it's like getting a refund on your purchase price. Say, well, the first thing I'm going to do, I'm going to pay $1 million for it. I'm going to go to the bank, get a mortgage for $500,000, take that out. The business and the earnings of the business aren't going to change, other than a little bit of interest. So I'm getting it like for half price or something like that. And then we look at the earnings and we say, well, the first thing we do is we look at the last typically 5 years of statements, and they're historical, and we're not valuing on the basis of history. When we do a valuation at a particular date, it's what's it worth going forward, not whatever it did in the past, but the history is a good indication of sometimes of what may go on in the future. So we look at the history and we try to carve out the weird and wonderful things. Well, let's say in 1 year they spent $50,000 doing renovations in the office. They're not going to do that every year, so we put it back in and say the earnings for that year were really higher, it's just that they did that renovation. Or they may have got a contract. They had one really golden year because they got a special contract that's never going to happen again. You say, well, I'm not going to buy the business counting on that revenue. Let's take it out and whatever the associated costs are. And we call that normalizing the earnings. So if you see a valuation report, you're going to see expressions like normalized earnings or normalized maintainable earnings or ongoing earnings, and there's various different terminologies, but that's what they mean. And then once we get to that, then we apply, we call it a capitalization rate, cap rate, and really what that is, it's a risk measurement percentage. So the more risky it is that you're going to get those normal earnings, the higher the percentage goes. It's sort of like prime plus in a bank loan. If you're risky, it's prime plus 4. If you're not very risky, it's prime plus 1 or something like that. Same kind of principle. And the way that we do that is we do it in building blocks. And we say, well, what's a risk-free rate of return? And the standard we all use is the long-term government bond yield. Because when we're doing a valuation, we're not looking at, let's go, generally speaking, sometimes you do shorter, but you're generally looking at forever for all intents and purposes. So you're looking at long term. So to use the 1 year bond yield wouldn't be really appropriate. It would be the long term bond yield. And that's, if the government goes, nothing's going to be worth anything. So that's basically the standard for the risk free. And that's really low right now. It's around 2 or 2 something. Then we say, well, that's debt. We're valuing equity, so equity is riskier than debt because the shareholders get paid after all, the creditors get paid. So you have more risk, and we had another layer for that. And then all the, we have a lot of public market reference type stuff that we use to get these, they're tracked and so on. And most of the public information are large public companies or well-established, certainly much bigger than the businesses that we're typically valuing. And there's a premium, we call it a size premium, to say, well, a small business doesn't have the same ability to, they hit a rough spot, they can issue paper to finance over the short run, they can, those of you that have gone through it, it's a lot easier to borrow $10 million than it is to borrow $500,000. Because the bank goes, well, I have the same paperwork, and I make a whole lot more money on the 10 million, so you're just kind of like a pain in the neck. So for all of those reasons, we add a size premium. And again, there's a lot of market information about what, depending on the size, what those premiums are. So we call those systemic risks, and they're just sort of, I'll say take them out of a book. So we all do the same thing, but then you get to the company itself, and you look at the industry, you look at the company itself, and consider the risks that are facing that company, both the industry itself and then specific to the company. And there's some things that they can control themselves and some things that they can't. So if you're doing a lot of US dollar stuff, well, you've got foreign exchange risk, whether you like it or not. You can do things to mitigate it, but over the long run, that could affect your profits and things like that. And then there could be internal things, like you've got one person that does, they're the key to the business, and if you lose that person, well, that could take a big chunk out of your profits. So we sort of add that all up, if you will, and say, okay, when we put all the pieces together, let's say, so I don't embarrass myself, we get to 20%. The multiple that you often hear when you're listening to stock market stuff, it's the price earnings multiple. Well, it's the same idea for us. If you divide that percentage into 100, that's the multiple. So 20% would be 5. But we do it we do a blended, both on the basis of debt and equity, and say, well, if a company is typically financed half with debt and half with equity. Well, the equity piece is 20 and the debt might be 8, and we do a blended rate, and then we deal with the debt separately. The reason I'm telling you all of this is because this is very subjective, and there's a lot of arguments about it. And when you get to some of the adjustments that we're making when we're doing normalized earnings and so on, that's where a lot of the arguments come. Whether it's the parties themselves that are arguing about it, or whether it's the valuators themselves that are arguing about it. So, that was just to give you a sort of a little bit of a context so that you can hopefully relate a little bit better to the stuff that I'm talking about now. So over the last 5 years or so, the economy's been up and down. Every time you open the paper, there's, Europe's going to fall off the end of the earth. Then they sort of get that solved, and then the U.S. has some problem, and then it goes back and forth and so on. But for a while there in 08, particularly toward the end of 08 into the beginning of, I guess depending on who you talk to, middle or later part of 2009, there was a big trough, and even solid public companies, their values were going down by 40% or 50% or whatever else, just cuts. So the valuations that we're doing, most of the time when we're doing matrimonial valuations, we're always looking back and saying, okay, well, I'm doing a 209 valuation here. The economy wasn't so great, so we have to figure out, okay, what's the impact of that? Some, like here in Ottawa, let's say, there's a high proportion of, because of all the government employees, of people that have dental plans and things. So if you're valuing a dental practice, is the economy going to make really that much of a difference? Because the plan is paying for it anyway. But car dealers were suffering for a while, and other things. So it depends what the business is, whether the economy had a big, small, or little effect on things. But when you are dealing with the person who had the business, oh yeah, the economy killed us. And then you look at the results and go, really? Like, it kind of looks the same to me. And then, yeah, that's right. I've gone, after so many years, you get a little cynical, and when you hear all the stuff. And then there's just how long. Is it a temporary thing? Is it a more permanent thing because a piece of the business has just disappeared and it's never going to recover? And some of the impacts on that capitalization rate. Remember the building blocks I was talking about? Back in 06, 07, the long-term government bond yield was probably around 4.5% or 5%. Now I've seen it as low as 1.5%. So the higher the percentage, the lower the value. So just all else being equal, like you're getting a higher multiple now because the interest rates are all low, and even the borrowing rates are low. But we're trying to look long term, and we're trying to make the adjustment to say, well, yeah, okay, they're low now. They've been low for a long time, but they could go up. And again, there's all kinds of talk of they might or they might not, and so on. And then remember that equity and debt, the premium, because we're dealing with equity here, that could affect that as well. So this might be down, but everything's riskier because everybody's fighting harder for less work or whatever kind of thing, depending on what industry it's in. But the big thing we've got to be careful of is double counting. Because we might, when we do that normalizing of earnings and make adjustments, and we're looking at a 5-year window and we see it dropping off toward the valuation date, let's say it's a 2009, so we have 98765, and we see it going down. So we say, well, even if we take an average, we're going to be lower. So is that permanent or not? And we might say, well, let's temper our whatever we're going to do. And so I'm going to have lower earnings that I'm going to capitalize. And the reason is because of the economy, and we're not sure that it's going to recover. Okay. So then we get over, and we start doing that capitalization rate and say, well, geez, things are a lot riskier now because the economy sucks. And so we'll jack up the rate. So we're adjusting the earnings and we're adjusting the rate. We might be double counting. And that's where we get into a lot of arguments among the valuators, saying, well, I allowed for that or I didn't. And if you read a valuation report, you will see somewhere in there the kind of the cover your ass paragraphs that says that you can't just pick, let's say, the capitalization rate or the earnings and say, well, he used a capitalization rate or a multiple of 4, but I think that's a little low, and I would have used 5, but leave everything else the same. So the wording in the thing says you have to look at everything together, because I may have dealt with the economy and the earnings, and my counterpart might have dealt with it in the cap rate or some combination of the two. So professionally, we're not allowed to do that. Like at one time, if that was the game, you'd say, well, so-and-so used 4, I used 5, the difference is 100,000, let's just split the difference. And so it was basically you get a higher value or lower value, depending on which way it was going, just because somebody said, well, I just changed this number. There's no basis for it. There's no understanding of how it got there. So we're professionally not allowed to give an opinion unless we do all the work. And that, I'm going to talk about cost benefit and all that stuff in a few minutes, but that's one of the things that when it gets down to the last steps, going, well, yes, I can do a valuation, and everyone wants to know, well, would you be higher or lower depending on which way they want it to go? Well, I don't know. I can't tell you until I do the work. Oh, well, how much is that? Oh, but there's no guarantee it's going to be whichever way you're going to want to go and stuff like that. But the economy is just the double counting and things. So in a report, you're always going to see that. You shouldn't look at just one thing or another, because you never know how they dealt with it. Okay, then we get to the owner's remuneration. When we normalize the earnings, somebody that has their own business, they can take out whatever they want. Because sometimes it's a function of tax planning, sometimes it's just a function of, we're buying a house, we're just going to take bigger salaries out so we can buy the new house, and we'll work it through the business over time and so on. With the small business deduction, the prevailing wisdom up until a couple of years ago was you'd always bonus down to whatever the threshold of where the tax rate goes from, say, 20% to 40%. That's not so common anymore. So sometimes you just get a big bonus, and all they did was they paid the source deductions and put the rest as a shareholder loan. So we say that's fine, but when I'm valuing a business and when someone's buying it, they're saying, well, what would it cost me to hire you or someone like you to do whatever it is you do for the company? And anything beyond that is really a return on your investment, because you're just able to take $400,000 out instead of $2 because it's your company and you can do whatever you want. But it doesn't mean that for the service that they provide, it would cost me, the arm's length owner, if I had to hire someone to do it, I'd only pay them $200,000, because the extra $200 that they're taking down, that's mine. That's what I'm paying for. So oftentimes we're asked, not in a matrimonial file, but on, I have some of my partners, they have a client that's looking to sell their business, and I say, okay, well, don't do the whole 9 yards valuation. Let's just do kind of the schedules, and we'll do the normalizing adjustments to give them an idea of what it's worth, sort of the theoretical value. And we say, well, what's an economic salary? And the owners aren't stupid. And they go, well, the lower the salary, the higher the earnings, the higher the value. So, oh yeah, it's $75,000. So then the purchaser comes along and goes, okay, well, I'll pay you the $1 million for your business. But here's the condition. I want you to stick around for 2 years and smooth the transition and, introduce me to all the customers and everything, and so that we can kind of wean you out of the company and minimize the impact of having the owner all of a sudden disappear. Oh, well, if I'm going to stick around for 2 years, I want $150,000 a year. Oh, just a sec. If I'm going to pay you $150,000, I'm not paying you $1 million or whatever for the business. And sometimes it's a function of tax because you can deduct salary, but you don't get to deduct your investment. So in an actual transaction, it's sort of dealt with one way. Now, when you're dealing with the owner of the business in a matrimonial valuation, the first reaction is going to be, I'm irreplaceable. I have no idea what it would. You couldn't afford me. The business is nothing without me. Okay. Because there isn't a book that you can say, well, company with $20 million of sales in this industry, president, $300,000 or whatever. You can't use the bank salaries because there would be no value. And you say, okay, well, what is it that you do? Well, I oversee everything. And, I'm the front person with, I'm in front of the significant customers and, they depend on me, and I'm the one that goes in and closes the deal, and, I overlook all the finance, I do all the strategic planning, and I do this and I do that and everything. Okay. So then you talk to the one that doesn't have the business. So what exactly does your former spouse do? Nothing. Golf course all the time, he's at the bar drinking, and with that damn girlfriend that he has, or whatever. And so it's like, okay, great. So, that gets very judgmental. And now you're attaching. So if I say the salary, the economic salary for that individual, let's say it's $250. And I have a multiple of 5 when it's all said and done. My counterpart says, well, I don't think it's 250, I think it's 200. Well, that's 50,000 times 5. That's a big difference. So the economic salary issue can have a big impact on the value of the business. Because really, it is very subjective and difficult. So we try and scientifically come up with a number, but unless you can get somebody who's actually doing it arm's length, and it's very difficult because the owner will always do whatever it takes. Even if you have professional managers, there's only so far that they might be willing to go before they're going to go, I'm not doing that, or whatever kind of thing. Because the owner, that's their money on the line, that's their pension on the line and everything else, so they're going to do whatever it takes. And so in family law, you get the arguments over, there or not there, how valuable they are, and the irreplaceable argument, and so on. And just an example of that irreplaceable, I was contacted by somebody. They had a valuation done. In this particular case, the wife was the owner of the business, and the husband was, doing some of the administration and things like that. So they had a valuation done by one of my counterparts, and he did his black magic or whatever and came up with a number. Then her accountant did a valuation, and basically it was way lower. So I'm going to say one was $1 million and one was $2 million. So what they were proposing to do was split the difference, because when I looked at the valuation report and plus what she was telling me, I said, it sounds like my counterpart might have been a little high, because she was everything. The customers are only there because of me. They tell me I am the business. Okay. And then the accountant is just saying, well, this is only the only sure part. The other stuff is who knows what it's going to be or whatever else. So he's got the $1 million value. And I said, well, I think I'd probably be lower given what you're telling me than my counterpart, but your account's really too low. So, probably your compromise in between the two is probably not a bad number. Okay, so off they go. Well, I guess all the other stuff that comes along about kids and income and all the other things that all have to be settled weren't getting settled. So I get a phone call saying, well, I need you to do a valuation, because you told me you'd probably be lower than. They're going back to the other valuation now. Okay. So now we start in earnest. So we start doing the preliminary stuff, and she's telling me, like, I am the business. You just ask my customers. I have a survey that I had someone do a survey of, it was one of the kind of a strategic planning thing, and they interviewed some of the customers talking about yeah, she's key to the business and everything else. So I said, okay, if we're going to hang our hat on that, I'd like to speak to the customers, because for sure, I know my counterpart. There's not that many of us in town. We're lucky. I know what he's going to do. First thing he's going to do is go talk to them. So there were 2 really big customers and then a bunch of little ones. So I said, let me talk to the 2 big ones. So I did. And I just said, I'm doing a tax valuation. And those tax people, they're a pain in the butt, and we have to make sure we satisfy them and everything else. So, yeah, sure. So they have no idea why I'm doing this, other than they think it's just for tax, and who cares? So I spoke to the first one, and I said, supposing she sold business, would you keep buying your stuff from them? Oh, yeah. As long as the price stayed the same, I don't care. Oh. Yeah, she's the face, she's the one that they were always dealing with, but not irreplaceable, which is what she was saying. So I said, oh, okay. Then I spoke to the next one. Same story. I don't care. In fact, one of my other suppliers sold the business, and we agreed to hang on, and uninterrupted, nothing changed at all. Oh, so I phoned her back. I said, I don't think you want me to do a report, because I'm going to be hired. And because he had, the other guy had done, he had allowed for some of that in his cap rate. He just jacked up the cap rate to have more risk that the earnings wouldn't continue. So I said, that's not going to happen. And if they talk to your customers, they're going to just throw my report in the garbage can. They're going to go back and do theirs over. So I said, just stop right where you are. And that's what she did. I said, just don't bother finishing. I only spent a day instead of 4 or whatever, and it just stopped there. And we won't do a report, and we'll just carry on. Now, if you want to make a business owner mad, or if you want him or her to go on a Dennis Miller rant, just talk about economic remuneration and the keenness. They're kind of related. They say, okay, there's double counting here. Because we do valuation for the business, and then there's the income for support purposes. What's the real income? That's the way it's put to us. And there may be income left in the company that can come out, and so on. So they'll say, you did the valuation, and you said the economic salary for me was $200,000. Even though they were taking out 4, we put the extra 200 in, and that's what's driven our value. So they go, okay, you used 200, did the value on the basis of 2. I've given him or her half. So, great. Oh yeah, now we're going to do your income for support. Your income for support's 400 grand. But wait a minute. The value has already got everything over 200 in there. It should be 2. I hear you. But it doesn't, nobody wants to take it, and it's going to take a Supreme Court case to solve it. And because there's 2 support. There's child support and there's spousal support. And for the child support, the prevailing wisdom of the courts, because the courts did change for pensions, because that's what was happening with pensions as well. Say, well, here you are, you're 44 years old, you're going to have a pension that's going to start when you're 65 or whatever, and here's what the value is, and you just put that in your property and divide it. Then they come to retire and go, oh, well, I'm no longer working, so my support obligation is done. Oh, wait a minute, you have a pension. But hold on now. You already got half my pension. So someone did actually, it went up the ladder and all that stuff, and the courts agreed that there was double counting here. As soon as all the owners heard about that, because it's like they have radar, it's like, oh, that valuation you did, and you did the income report, you've got to go back and change that, because it's different for pensions now, but not for businesses, sorry. Because for income, for child support, you say, well, it's really, the theory is kind of, it's a child's right to a share of your income. It just gets paid to one or the other parent, but that's kind of what the theory is. And they go, well, the kid didn't get half the business value, so too bad, sucks to be you. You're going to pay on the basis of the higher number. The courts have somewhat, sometimes if it's spousal, then they might take that into consideration and say, okay, well, you've got half the value of the business. You don't need as much spousal support as you might otherwise have needed or whatever, but it's not cut and dried. Somebody, at the last valuation conference I was at, somebody had gone through however many cases there were all across the country, and it's all over the map. But if you want to make a business owner mad, just start talking, or hear them rant on about that whole double counting issue. And to some degree it has merit, but nobody's going to spend the money to run it up the ladder because it costs a fortune to take it to the Supreme Court or whatever. All the landmark decisions are the rich people. So when we come to goodwill, only commercial goodwill is capable of being sold. That's the only one that has value. There's personal goodwill, there's individual goodwill, and then there's like all the others, goodwill of location, product, and all the other kinds of things like that. But personal goodwill is unique to the person. So, for example, golfing's a bad example because I'm not a good golfer either, but if I had a golfing business or whatever else that depended on my ability to win in tournaments or whatever, I can't sell that because my income is because I'm a good golfer. So I can't say, oh, well, here, buy my business and you'll win all kinds of stuff on the PGA Tour too. Not going to happen. So that's what personal goodwill is. You can't sell it. It's unique to your skills or whatever that you personally have, not a skill that you can be trained to do, but whatever it is. Individual goodwill is sort of once removed from personal goodwill. It depends on an individual person, and so if that person were to be removed, it would be somewhat harmful to the business, but not necessarily totally detrimental. They could be replaced. So that lady that I was talking about in my example, in her view, it was personal goodwill, but it was really kind of more individual goodwill or really just average goodwill. So what happens a lot when you're dealing with these things is people look at the financial statements. The lawyers are guilty of that because most of them really don't understand a lot of and that's not their job. That's why they have me. Or their client is looking at it and saying, well, they're doing $6 million of revenue a year. They're making $1 million, but there's no goodwill value. That's impossible. Well, depends how the business gets its revenue. So companies that generally do bid and tender, they don't have goodwill value because they bid on every job. So why would I buy your business that's based on all the bids you won in the past? Why would I buy your business on the basis of that you were able to get $6 million a year? Why don't I just buy the stuff and bid myself? It's a lot cheaper. And that makes the one that doesn't have the business crazy because they're going, yeah, but it's making a ton of money. Just get it in support. And then there's that key person issue and that fine line in that example that I was talking about where, is it just a key person that if they were removed, it would hurt, but not detrimental, versus personal that would just be if they were gone, everything is gone. So that you're going to run into that when you're talking to people a lot.
So if someone has a rocking big Pittman insurance policy, that would be a factor?
It could be. Pittman insurance is really, in many respects, a way to get liquidity for the business. So if that person dies, it's either a way to buy out the other shareholder or whatever without taking any money out of the company to settle the estate or those kind of things. And if it's just a not a tax planning, but a planning kind of thing. It's not necessarily that you have to have it for the business. But it's a factor that we would take into account and say, okay, well, if the bank says, I want Pittman insurance, then, that has a different connotation than, okay, well, we're just, covering all the bases here in case one of us drops dead, the other one can get.
That's partnership.
Yeah. But even, a life insurance policy on one of the 2 or 3 key shareholders or partners or whatever kind of thing, that's, if the bank or the lenders are insisting on it, then that's different than if it's just because we just want to, it's just part of what we're doing sort of thing. Okay, then, how am I doing for time here? Then we're going to get to, you're going to hear all about an unreported income. And that has an impact both on valuation, often more on income reports. But the one that does not have the business will come and say, well, the company pays for everything. That might be true, but where is it being, how's it being treated in the financial statements? If it's just being charged to a shareholder loan account and not included in the expenses, it's not reducing the income. So it doesn't matter for valuation. But that's where the company's actually cutting checks or putting things on the credit card. But what about, the home renovator that, comes to your house and says, yeah, I'll renovate your basement. If you want me to invoice you, it's $15,000. If you want me just to do it for cash, it'll be $12,000. And the 12 never gets reported anywhere. And so you'll see people's, when they give you their tax returns and everything, they live in a massive house in Manotick and 6 cars and whatever else, income $40,000. But the problem becomes it's hugely expensive to prove it because you have to prove it. And the burden of proof shifts from the one that has the income to the one that doesn't. And so, it's like a process of elimination. You say, well, I know it's not because they're drawing down on their line of credit. And I know it's not because they're collapsing their investments. And, I look at the credit cards and all the checks and I don't ever see anything for groceries or travel or any of those things. It's just, the stuff that has to be on paper or whatever. And that's the other part of the problem. There is no paper, so you're always guessing. And I have one now that I'm working on right now at this very moment. It's going to trial in November. But $40,000 of income. Did a little bit of income splitting with his former spouse and kids, maybe another 20. Bought a Corvette and used the line of credit for that. And paid off the line of credit, like, whatever, 80 grand or whatever a Corvette costs. Then some other souped up car. That's just cars, let alone, I haven't seen a single thing for, there's a Rolex in there too. Because the wife was smart enough to run around and photocopy and grab invoices and things like that. But at the end of the day, it's always, how much time do you want to spend? You want it to be beneficial. There's no sense paying me to do all this work. Go, well, guess what? It's got I can narrow it down to about an extra $5,000 of income. That's in support. That's not going to make a whole lot of difference.
Would a recommend phone call to Revenue Canada be beneficial in this negotiation?
Thanks for asking. I get that all the time.
Just thinking.
No, and my reaction was first, you can just call up. If CRA were smart, they'd just sit in family court.
Yeah.
But you say, okay, your ex-spouse has a business that's worth whatever, you're going to get half the value of that or whatever. There's going to be some support. You call CRA and they start going back, and then it's fraud, so they can go back as far as they want. And they don't have a budget. Like, we're their budget. So if they're there for 6 months, going through every single thing, they're going to do it. But we always have to balance, fees and benefit and all that stuff. So they get a massive honking big tax liability. Okay, there goes your half interest in the business because now you will CRA. They're going to jump the line on you. So I get that call all the time saying, I'm just going to call CRA. And I go, well, before you do that.
I'm saying you should just threaten to call.
Oh, I say that for sure. And I've seen that a couple of times too. And, walking up the court steps going, oh, I invited my friend from CRA to come and listen. Oh, well, maybe we'll settle. But you have to be very careful and not, kill the goose, even though the goose might be smaller than you would like it to be. At least there's something.
Do you find that people actually try to increase their inventory in huge amounts, and especially in industries where they can do that when they start to look at getting a divorce or a separation?
Yeah, they do things. I have another one that I want to do this, and I'm going to need, like, the business makes a ton of money. And, well, I'm gonna do this, and I'm gonna do that. So then they have to go to court and say, well, like, where's the plan? You're just doing this. But even if they do that, when we're doing the valuation, we'd say, well, how come your inventory is so much higher right at V-Day than, it's always been 100,000 and now it's 3.
Okay.
Do you really need 3? And we'd say, well, maybe not. So we would put that back in the value, adjust for it.
Okay.
But there are lots of tries.
No, exactly.
Yeah.
Because I've certainly come across that in a couple of
Yeah.
my clients. And trying to prove it without spending a lot of money.
Yeah.
And forensic accounting is, most of them have no money. That's the problem.
Well, that's the sad part of it. And it's, okay, I'm just going to make you keep paying guys like me to do it, and you're going to run out of money, and then I'm going to win. And that's the sad part of it.
That's exactly how they say it. I'm going to play this game until you can't play
Yep.
it.
Oh, yeah, exactly.
It probably gives us a run on how long they've been designing it.
Oh, there's a couple that I've been working on. You can tell that it's been planned. So even when you look at that 5-year window or whatever else, this was planned. Like, you can tell. But then you got to prove it, and that's the problem. Yeah. Oh, yeah. Yeah.
If you call CRA in and CRA calls it all back, are you allowed to use CRA's records?
No, we can ask for the correspondence, and
Or you
because
can ask for their tax returns. Can you ask for, like,
we can ask.
business of assessments from CRA?
Yeah, we often ask for that, especially on income where they've been deducting all kinds of crap in the company, and they got audited in, let's say we're looking at 8, 9, 10, and CRA did an audit in 08, and they put it back, all kinds of entertainment and travel and personal stuff. You say, okay, give me the audit, because they always come first. They have a letter saying we're proposing to dissolve, and they give you all the details,
right,
so that you can fight them, kind of thing, if you want. And so we'll use that and say, well, CRA did basically a thorough audit and added back $100,000 of income, so we're just going to do the same thing for all the other years. And the judges aren't stupid. Like, they know all this stuff goes on, but they got to balance that proof thing too.
But that's sort of a proof thing. If you
Yeah.
get a year with CRA
Oh, yeah.
audit.
Yeah. So when we do an income report, we always ask for, okay, give me all of your correspondence with CRA in the last 5 years or whatever else. Sometimes the spouse that you're acting for, yeah, I know, he came home bitching about CRA, so I know they were in there doing something. Okay, give me the audit results.
So
And
do you
they-
have
and they
to
lay
get
it all
them
out.
to sign a form for CRA? Like, I know for individuals, I get them to sign a form and I have access to their CRA file
Yeah.
online for all years. Can you do the same with the business?
Yeah, well, we can get it through the CRA will have given them, like, if we wanted all the details of the audit, but CRA, when they do one of those going through all the expenses things, they'll itemize.
Right. But I'm just thinking,
Everything.
does the guy have it, will he give it to you, or is it just easier to access CRA?
Sometimes it's easier to get it from CRA, but most of the time the court can compel.
You can tell us.
Yeah. Otherwise, what happens if they don't cooperate is that what's the term? Strike their pleadings, and then basically they're defenseless. Like it's like you thumbed your nose at the court. I'm not giving you anything, and the judges typically get angry, and they'll dress down the person's lawyer as well, because some disclosure is just fundamental, and it takes forever. And by the time you get it, now another year's gone by, and blah 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 blah. And they'll go, and that's the expression, is strike their pleadings, and basically whatever you say is uncontested. And so that they can't defend themselves. So the judge will take whatever it is you do. Now that doesn't happen often because they're kind of caught between a rock and a hard place. But they'll often they'll do a motion and they'll say, okay, you're going to give Steve or whatever all the CRA stuff and everything, and you're going to do it in 30 days, or I'm going to strike your pleadings, and then they have to cough it up.
So if you had something like a restaurant business where there's a lot of cash flow going through,
Yeah.
The spouse knows that a lot of stuff has been paid for cash, but how do you even find proof of that?
We do what CRA would do, that you do like a net worth, so you pick 2 points in time and say, okay, here were all your assets and all your liabilities and everything, let's say 3 years ago. And here are all your assets and all your liabilities now. And we'll get all their credit cards statements and all the bank statements and all the loan statements and everything else, and say, well, this is what you have on paper. And then basically say, well, you had a mortgage of $200,000 3 years ago and now it's only $80,000. Well, that's $120,000 of after-tax dollars. If I take what you reported, take the tax out, how exactly did you make all those payments? And you just kind of work backwards. But that's where it gets very expensive, because you're kind of eliminating possibilities. So the poor, typically woman that's getting screwed over on support goes, I can't afford to pay for someone to do that. And unless they can get some motion to say, okay, well, the husband is going to pay for me to do that work, that's what happens. Like some of the horror stories that I've seen. And there was one, I'm telling you, usually we get document briefs, like, here's financial statements and here's all the tax returns and all these nicely bound little books. Well, I got a box full of those books with all the stuff. And the last one, there were pictures it was just pictures. And it was pictures in, I guess, his girlfriend in various states of undress or whatever. I don't know how she got them. But there was a whole section of pictures, like the fridge door open, the freezer, cash. There was cash everywhere. The lawyer came to me and said, yeah, she paid my retainer, $40,000 in cash, because she just grabbed all the cash out of the house, but there were pictures. So, here, what could be more obvious that there's cash? But the trouble is, what's a judge going to do? And say, okay, I agree, there's cash. How much? Yeah. But, I think they go on a scavenger hunt in that house. But that is such a huge issue. And on a valuation, say, well, I valued the company on the basis of the earnings that I saw in the financial statements, but all the stuff that's not there, well, I'm not going to know about it unless, we have something. But even if someone were buying the business, are they going to pay for what they don't see in the financial statement? Say, I'm selling my business, this is what you see, but there's an extra $40,000 that, I'm not reporting. Are you going to pay for that? Probably not. I said, well, I'll take my chances.
So I guess the cash wouldn't show up through bank statements. Or
Well,
these are the
no,
receivers, so
no.
it's true, yeah.
Yeah.
Or is it, people never use
Yeah.
visas either. They never yeah.
Wouldn't that be a clue though? They never use charge cards?
Well, that's what we try, that's what that exercise is. Okay, and we say, okay, Your Honor, I've gone through all the credit card statements. I haven't seen one stick of clothing. I haven't seen any groceries anywhere. I've got the bank statements. It's not in the ATM machine because they're paying with cash. So I haven't seen this, I haven't seen this, I haven't seen this. So first you're establishing that, okay, it's a business that lends itself to cash like a restaurant or the contractor. So, okay, Judge, you agree that there's probably cash here, yeah. But then it's trying to quantify it.
They aren't making them, they haven't eaten them for 6 years.
Yeah.
We also use their family.
Yes.
Right. You must, and or their new girlfriend or their new
Yes.
boyfriend or whatever it is.
Yeah.
Because in my both my cases that's happened. So the money's being loaned out, and then things are purchased for them by other family members and or
Had that exact situation.
right.
This fellow lived with his girlfriend, and she was paying fairly. But trying to get the third-party records is that's a tough legal hurdle to get over. We'll give you yours, and there's no doubt in my mind there was cash. But trying to, everything was well, his debt went up by a certain amount and so on, so some of it was living off debt. But, oh, well, like, where's your groceries? Oh, my girlfriend pays for that. Oh, where's the kids' stuff? Oh, my girlfriend pays for that. So, you know, whatever the legal fight that was going to have to go on, it was like, okay, I'm going to spend so much money that it's not worth it.
The best revenge is when you put everything in your girlfriend's name and then she leaves.
Yeah.
I had that happen too. She got it all because he couldn't exactly go to court and say, well, that was really mine.
Yeah, what's the, the enemy of my enemy is my friend? How long over time?
It was all long settled when she did that. My friend had already got nothing.
I mean, to some degree you get kind of cynical when you see all the crap that goes on, because I get all the transcripts of all the examinations, so you've got, you know, I have to go through and pick out the financial stuff for income or valuation or whatever, but you also get all the stories of, you know, beating the crap out of her and all that other kind of stuff, because it's all part of the thing. It's like, well, I live in a sheltered world. Trusts are they're such a great tax planning tool, because in the old days it would be, okay, let's incorporate a company and we'll have 47 different classes of shares, so each one ever so slightly different, so we could pay a dividend on this one without that one, and we could get income to spouses and children and relatives and all that other kind of stuff at the lowest possible tax. And CRA was always taking runs at it, saying, well, they're not really different, but, you know, well, legally, yes, this one is entitled, ranks ahead of that one, so it's different. And then, however it evolved, trusts became the magic tool. And you can be flexible, you can do this year one thing, something else, you can have everybody and their dog on the list of beneficiaries, and you can just say, well, I just never give anything to that person or whatever. And typically, the trust, ideally you have three trustees, and it's typically mom, dad, and a friend, either dad's friend or mom's friend, depending on who's really got the dough. And that sort of makes it look, you know, because you're really trying to make it look legit to CRA. And, you know, then you've got the holding company and all that other kind of stuff. So then the divorce comes along, and the trust owns the shares that have a big chunk of the value. And whoever, husband, wife, whichever one has the business, goes, well, I'm only one of three trustees. Mom's going to be booted in a few days, but we'll replace her with an arm's length person. I have no control over that. That's up to the trustees. So that's a big fight, and it complicates everything. And sometimes they'll say, well, we really meant that to be for the kids, so we'll leave it and change whatever. And sometimes it's, well, it's really yours. You're going to end up with it anyway, and you can control how it goes out. Your buddy just, you sign here kind of thing. So most of the time it's attributed to whoever gets the business for the family properties. But there's lots of fights on those. And actually I'm working on one right now where they set up a family trust, and the husband, the wife, and 3 or 4 kids, I forget, they were the beneficiaries. There were six beneficiaries. Then divorce comes along, husband hits the jackpot, sells the business, like we're talking millions. And first, he was trying to say that the business wasn't worth anything because, you know, it was a contracting kind of business, but, you know, he never had a valuation done. And so they get, I think it's an 08 or 09 divorce or whatever else. The business gets sold about 2 years after separation, but nothing has been solved. It's been going on and on and on and on. So they're arguing over, okay, well, where does the trust belong? So, you know, is the wife whatever 1/6, 1/4, whatever the number of people beneficiary? So 1/4 of the value would really belong to her. And he goes, well, no, because there's no right. it depends on what the trustees say. And oh, by the way, I'm not the only trustee. Well, the brother's the trustee too. And so, there's no obligation to distribute that wealth to that beneficiary. So that's the big legal fight in this particular one. But since then, they created a new trust, and they took all the assets out of the old trust, and there are now there's one less beneficiary. Mom's out. So what did it? It's big dollars, and they both have the money to fight the fight, but most of the time they don't.
In the case of a 21-year wind-up, like at that date or in that year of separation or divorce, would that have an effect on the value at all? Because, unless they rolled it all in, I guess, but would that have a value on any of this?
It could, and it gets kind of speculative,
Okay.
and that's where the arguments come and say, well, our original plan was that this was going to go to the kids because 20 years from now or whatever kind of thing. But then, oh well, wait a minute now. It was never intended to go to the kids. It was really, or it was intended to go to us. It was our retirement, and we were using the trust to funnel money to the kids at a lower tax rate. But really, that's our retirement fund. And oh no, wait a minute, no. Did I say that? I meant it was all for the kids, so it's not mine. But the 21 year, when would it be wound up, and where's it going to go? And it just goes on and on and on.
In the case you were talking about, I'm assuming the corporation was inside the trust.
Yeah, the trust owned the shares of the corporation. Yeah, because they had done a freeze. They had originally I think it was just the husband. It could have been the two. The husband and the wife were the original shareholders of the company. They flipped them into a holding company, and the trust owned the shares of the holding company. And so everything basically went to the trust.
Is there's some chatter about testamentary trusts and being brought down to more like an inter-vivus trust, and is that going anywhere? Are they trying to make different rules or not give the same benefits as for testamentary trust?
Yeah, it's sort of scaring all the tax people in the office because they've done all these things and now it's like this.
I know grandfathering, I heard that that's the chatter I'm hearing, but I just wondered, would that have an effect?
Oh, for sure. Because when we start out, like if we value the company and say, okay, well, mom and dad have preferred shares, and there's maybe a couple of employees have shares, and then the trust has these other shares. Who's going to get the value of the company? And if the trust can't be the conduit anymore, then maybe the value would be attributed somewhere else. Because at the end of the day, let's say the company's worth $1 million, we say, well, it gets divided up. But on paper now, really everything except whatever the redemption value of those preferred shares belongs to the trust because it was fixed. That's the only way to make it fly for tax. But now if they're going to change the rules on the trust, where does the value go now? And I've heard some chatter, but I haven't heard anything
Not definitive.
definitive yet.
No, I haven't heard anything definitive, but I know there's a lot of talk.
Yeah, there's a lot of interest in trusts at CRA. And they started with all the offshore type things and those donation scam things that where you make a donation and
Well, those should have been attacked.
Yes.
So what's your case with this one? And this
what they're
corporation?
trying to do is to approach it not from a family law perspective, but from a corporate law perspective, and say that the husband had a fiduciary duty as a trustee and as a shareholder and officer of the company not to deplete all its assets, and say you basically stripped out all the value and moved it over here, and you will press this shareholder here, which happens to be the wife in this case. And that's the angle that they're going to go at.
So are the trusts something then that you need to caution clients that this is probably not going to fly if something goes wrong with your marriage?
Oh yeah, if I want to just have some fun, I just go down and tell the tax people horror stories. So I said you should put in there to say you should make sure you talk to a family law lawyer about what all this means if this comes unraveled at the other end of down the road kind of thing. Because what you think you're getting, you may not get. That sort of thing. So they're starting to qualify and see that a lot more often now.
And what I see often is wealthier parents like encounter. We have some people who've done very well with their companies or their options, or sold, only junior oil and sold out and there's a lot of money. And so they start a family trust because they want to protect their children from getting married to someone who goes after the family money. And in fact, I've seen this with friends.
Yeah.
This exact situation happened where a young man was married. She was gone within 6 months, and immediately after becoming trustee, she knew there was money there. So what's been your experience with that, and has there been any success in people challenging these family trusts and getting settlements?
There's some, but if it depends when it was set up. Like the more recent ones, the more someone found a loophole and then they kind of address it. So the newer one, like they're being a lot more bulletproof kind of thing. But there's some that they go back in time, when even one that goes before they changed the Family Law Act even. It just kind of, and now all of a sudden what was excluded is no longer excluded because the law changed on them kind of thing. But I'm seeing more and more runs at the mom and dad's family trust because one of the kids now is getting a divorce. And it's not been consistent. No. And a couple of conferences ago they had a lawyer at our valuation conference saying, show me a prenup or whatever, and I'll tell you how to get around it.
For that reason, they're not really holding up as well as they would.
It's a source of big argument. I mean, because I guess the lawyers will interpret it the way they want, and then they try and say, well, I only signed it, but you didn't give me all the financial disclosure, so I kind of made an uninformed decision, so they'll throw it out that way. Or, I was under duress, or this or that or the other thing. And that's how they're opening the door and saying, well, it's not really a contract because he or she, as the case may be, didn't really know what they were talking about because you didn't tell them everything. Yeah, that's typically the way they attack them. But again, it's still it's a huge legal hurdle to get over that. It costs a lot of money to fight the fight. And
You're better off having it not.
I mean, have it. I mean, as best you can, kind of thing. I suppose. I mean, it's better than not having anything at all. It's just a question of if push came to shove, depending on the amount of money involved and so on, it could be worth the cost of the fight.
Yeah.
I think the best part of freedom is you get to discuss them.
Yeah.
I've seen people break up if they didn't break up because they realize that it was going to be made or financial problem, so they just don't even get married.
Yeah.
It's probably the most valuable part of freedom.
We saw a case 2 years ago where she would sign the prenup, and he was very uncomfortable, but went ahead, and they're all split up.
Yeah.
So
He said throw the party. He said it was better
he said throw the party, but don't marry her. He actually started to cry in my office. This is not a good sign.
Well, it's because they run around. I've had seconds. What do I do? Leave them? Yep.
Yeah, it should be a county sign.
Yeah, that's my point.
Yeah, really.
That's my point.
Yeah, you'd think, but love is blind.
Nothing, I didn't want to sign it. We're talking about
And are you finding you're getting more? Like, are you getting more needs for your services?
Yeah, I mean, whenever there's a business, almost always there has to be a valuation done. And I mean, sometimes it's a relatively simple one. Like I have some now where I'm not even doing a whole 9 yards valuation. I'm just walking the line of the standards and saying, okay, I'm not doing a whole valuation, but it's basically a one person who works through a corporation to protect from liability in case his business gets sued or whatever else. And like, there's no goodwill value in that. So I say, well, I haven't done a whole 9 yards valuation, but I don't think it's likely that there's any goodwill value here, and see if that works. And oftentimes, it gets to the other side, and the lawyer gives it to someone like me and goes, yeah, you're not going to win this battle, so stop.
Right.
Rather than say, okay, I've done the whole 9 yards valuation, same conclusion, but instead of, cost 5 times as much or whatever, because I've got to do all this stuff. Yeah.
Yeah.
So I haven't gotten into any trouble yet.
Right.
But I mean, it's, trying to be practical and
Yes, of course.
whatever else at the same time. It's like, I'm lucky I have lots of work. I don't need to manufacture the work. I'm
Yeah,
lucky
yeah.
that way, but
I just was wondering if there's more calls because there's more of it coming.
yeah, it's been, if I look back over the last, I'll say 20 years or so, I don't know that there's any more or less. I think the spending is a bit smarter now.
Okay.
People are trying to be more careful. Okay, before I'm going to spend a fortune on a valuation and then have the lawyers fight the fight and everything else, right? We might try mediation and we might do a joint. We'll agree that we'll get so and so to do it, and whatever he or she says, that's what we're going to go with, we can do 3 levels of report and do the lowest level of report to give them a basis to negotiate and say, okay, it doesn't mean that what you do is different, it just means how much supporting documentation that you look at. And so if we do sort of the equivalent of a notice to reader financial statement instead of an audited statement, so they have some parameters to work with. Because oftentimes they've got a number in mind that they can agree on. It's just, the lawyer isn't going to do anything until they get something officious from somebody, otherwise they could get sued for malpractice. So they say, okay, well, we got this done and we've negotiated our settlement and save a lot, keep the money in the divided pot instead of making the lawyers and evaluators rich kind of thing. So I'm seeing a lot more of that, a lot more mediation and arbitration, partly because it takes so long to get to court. And partly just because of the cost.
What is the cost? What would an average cost be?
There's 3 levels of report, like the notice to reader equivalent, the low level, depending on the business, it's probably around $5,000 or $6,000. To do the one that I go to court with, the middle one, I've done 2 comprehensive, which is the highest level one in my entire career, because it's prohibitively expensive. And financial statements, it's the report of the accountant is like 1 page. It's like, I did this. The statements look exactly the same. But if I'm doing a valuation or I do that middle one, and I know we're going to be arguing over owner's remuneration or something, I can do a little bit of extra to stand up to cross-examination on that and say, well, how did you get that? Well, I did this and this and this and this, whereas in a financial statement, it's, I reviewed them and they're okay or whatever. I didn't find anything wrong with them or whatever that one standard paragraph that would be the same audit report that it's on IDM statements as it is for Joe Scratch kind of thing. So the estimate report can be, it's probably about half of that again, because the principles are the same. People say, well, which one gives you a higher or lower value? And it's like, well, it's not that you do different things. It's how much work you do to make your assumptions or draw your conclusions or whatever kind of thing.
So $7,500 for a mid-level report?
Yeah, somewhere in that neighborhood, depending on the part. Yeah. But that the one where I was saying that shortcut thing that I do, like I just did one just yesterday, and it was like $1,000. I just talked to the owner about how does it work, where do you get your revenue, and whatever else kind of thing, just so that I could say, okay, I spoke to them, this is how it works, and if that's the case, it's unlikely there's going to be goodwill value, and they're going to try that. If they have to get a valuation, well, it's not wasted time. I'm still going to have that same conversation. It's just that I'm not doing all the other stuff.
Businesses do change over time. Are you called back in 5 or 10 years down the road because a business has greatly grown or fallen off the edge of a cliff? Or?
Yeah, I mean, typically there's like a divorce event has to happen or whatever kind of thing. So, I've been back a couple of times where the owner's gotten divorced again 8 years later or whatever. Kind of thing.
But if I divorced somebody whose business was valued at $2,
Yeah.
or $2 million, and 5 years later it was valued at $14 million,
Yeah,
I'd probably want that reviewed.
yeah, that happens.
Yeah.
That happens. And you get into hindsight and everything else. So when we do those kind of things to say, okay, valuation is at a point in time. So whether what was known at the time that I did my valuation, that was there a pretty good idea that it was going to be sold for a whole lot more later or not? What was in the wind? Because if the owner's got that in the wind and wants it to be low, they're not going to tell you everything. So we're careful to say, we get them to sign a letter saying you've told me everything I need, so I can not get sued for saying it was 2 when it was really 14 kind of thing. But that happens a lot, especially when it's, I'd say within, say 5 years or so of the thing. You get back and say, well, hold on now. Someone did a valuation and said it was worth this and just sold it for that. And what happened? And that's a little bit about that one I was telling you with the trust. They said there was no value. They used book value. Goodwill value was in the millions.
Or conversely, if somebody's paying huge support and then the business has dried up.
Yeah, the support's generally, like, you can always go back and ask for a variation or whatever. So let's say I've done an income report for the first 3 years after separation, and then the business is doing better or worse, and then I'll be asked to go back and say, okay, I need you to update your report because one or the other is claiming the income's higher or lower depending on the circumstances, and we'll update it. Well, I mean, when they did all the guidelines, they started with the child support guidelines, and then the spousal support guidelines. It's more or less the same approach with a few little variations and so on. And the theory was, let's keep the accountants and the lawyers out of it. If you just have a T4, income, 2 kids, Ontario, boom, here's the number, and it's pretty straightforward. But it's the ones with their own businesses, either proprietorships or partnerships or companies where they can control that income that they put on their tax return. And they can jump through the business. That's really when we do the income reports, we say, okay, they left money in the company, could it have come out? That's step number 1, without hurting the business. Oh, I was taking out $400,000 a year, and I just paid myself $50 this year. I left the other $350 in the company, but if it could have come out, the court doesn't care why you did that. It's good tax planning. We're not going to do that, but for the support calculation, we're going to pretend you did. And then it's, okay, now in all the expenses that are deducted, how much of the vacations and all the travel and the car and the phone and like all the gamut of personal stuff, the life insurance and whatnot. Everybody in the family's cars getting their gas paid or whatever. And then that's the next part, and then the hardest one is, okay, now there's the unreported stuff.
So you had mentioned about the stock options, and I'm working on cases collaborative, so they're agreeable to what they're going to do, and they decided because the stock options were an issue, and they decided they're going to deal with it as a level support calculation when it gets exercised and sold, because the valuation is problematic. Is that what generally is being done?
That often happens, yeah.
Because it is kind of bizarre to develop.
Yeah, it's easier when it's like a public company one where it's where they really don't have any control over the option value. They just happen to be an employee. Even if it's a private company, they don't have any control over what the value of the options and all those kinds of things. So often it's, okay, when I get it, you get half, and away you go. But sometimes they don't want that.
Right.
Depends how amicable it is.
Yeah, well,
Yeah.
no, this is a collaborative case. They're
Yeah.
playing ball,
Yeah.
so they're being reasonable.
Yeah.
And the fact that, yes, I know I'm going to get it sometime, whatever it is, it's gravy great.
Yeah.
But yeah, I can see in some cases somebody's going to be like, no, I want it now. That would be difficult. Would you be called in for something like that?
Yeah, so we'll value the options, and I guess the courts kind of accepted Black-Scholes, which is that black magical formula to do it, and but you get into all kinds of arguments about the assumptions and the discounts that get applied for this, that, and the other thing, and whatnot. So the options, how am I for? I'm good. Because options was one of the things, and that was, that kind of process where it's let's just wait and see. And oftentimes in there are other situations, sometimes with a trust, and say, okay, let's just see what comes out, when and if. But the courts generally don't like that.
Right.
But you can agree in a settlement. You can agree to whatever you want to. So, and if that's the best way to do it, then as long as you trust that you're going to get all the information to say, okay, I got this, and it's true. But when it's the owner of the company at the same time, that's more likely to not happen.
Yeah.
Kind of thing. But even the concept of value, like options, if I'm working for a company and they give me stock options, I can't sell those. And I'm going to leave, and they're going to give me 6 months to exercise them, and if they're underwater, I'm not going to get anything. And that drives people crazy too, because when you do that Black-Scholes thing, they may be underwater now, but because of the volatility and all the history and everything else, it's like they could be above water sometime. And there's certain assumptions in there, and so whoever's got the options is going, okay, the exercise price is $5, and the market value is $3, and you're telling me that really they're worth $6 because they're so volatile that you might just get volatility up at the right time and cash in. So options are a big sticking point. And let's wait and see what happens when I can actually exercise them. It's often happened. But from a fair market value point of view, they have no value.
Right.
They have value to the person who holds them, but they get counted.
Right.
How much does it cost to have option value? And one file?
Yeah, it's not very expensive process. It's probably around $2,000 or $3,000 kind of. If we don't have to value the shares themselves, so if it's publicly, if it's a public company or whatever, then the ones that get tricky are where it's a private company, so you don't have a valuation per se. And sometimes, because of the accounting rules now, when companies are paying their employees with stock options, they have to record the expense now, so they have to value them. And we'll say, okay, the auditors have gone in and done this Black-Scholes calculation, use that. They're independent, and rather than do it again kind of thing, because I'm just going to rely on what they did anyway. So it depends on the circumstances. Sometimes you can get, somebody did an investment like a high-tech, were common like that for a while, where you get various investments that kind of strike a value, and you can use that as a basis to say, well, that's the share value, and then the option value is a function of the share price.
And it's the same for shoes?
Yeah, it's virtually the same exercise.
Well, and I think in some cases, I suppose if you had a valuation done and you settled your situation, the way that they've changed the laws, you can still go back. If something happens to that tech stock and they develop something innovative and all of a sudden it sells for 100 times more than the valuation in the divorce, I think that they're allowed to go back and
They can certainly try, and they certainly will try, and then they got to go over the legal hurdle kind of thing. Yeah, but it's got to be worth worth the money to.
Yeah.
And people don't want to hear that. Like, yeah, it's worth more, but you're going to have to, pay me to do whatever I do.
Sometimes it's a little more, but in some of these tech companies,
oh yeah,
it's not a little more, it's millions more.
Oh, when it's millions, it's always some, because it's worth the fight kind of thing. But someone who had options for some fractional percentage of a company because they were employees there, and it's just not worth it. But it's still like that's the I'll say problem or whatever with the matrimonial. Like it's not a business deal. It's like there's a big emotion thing in there, and they're just okay. And, whatever. Like I've had people tell me, I want you to go through all the expenses in the company, and I want you to find every little thing. And I go, well, it's going to be expensive.
It's emotional.
And I don't care if you find one thing, I will be vindicated. And I'm going, I call the lawyer and go, I think you need to talk to your client because she's going to be mad at somebody, probably me and you. And then they kind of say, okay, it's ultimately the sad part of it is from the stuff that I do, it's a business deal. Okay, we split up, and we're going to negotiate how we're going to split up the stuff. And that's what it is, but it's not like two companies or whatever else. Because even when I do damages, like for like a civil suit, you've got the finance people in each company or whatever else, but it's not their money. They don't care. Okay, the company's getting sued, I'm the finance guy, and I'm going to do everything I can to get it down, but unless it bankrupts the company or whatever, it's not my money. I'm still getting my salary and all that stuff. But when one lawyer, he's a pretty funny guy. What happens when we get a file, like the first thing is, okay, here's the stuff. So somebody did a valuation, or I've got this new client and they have a business. Tell me what you need. So you sort of have this flurry of activity to say, okay, I need the financial statements and the tax returns and da-da-da-da-da-da. So you give them the list of all the stuff, and then nothing happens for a couple of months, especially when it's got to come from the other side. If it's the one that has the stuff, it's sometimes faster, but not necessarily. And nothing happens. Then you get it all, and you figure out, okay, I'm still missing some things, but I'll get started. Do your report. Nothing happens. And then, 6 months could go by, because they're doing other stuff or whatever. So I asked him, I said, Gary, I said, what is that? It's like, Steve, you got to hurry up and you got to get this done because, you want to get it done. He goes, well, here's what happens. They're really ticked off. They come and see me. I send them over to you. You tell them what you need. We get it all. You start working on it. But, it's costing money and, things are kind of going along. There's support being paid. And, there's no sense of big urgency. But then, one or the other goes to the grocery store, sees him with a new girlfriend or boyfriend. Monday morning, I get a call. And then all of a sudden, Steve, you got to get that done right away.